Anyway, we're thrilled to have Rob here. I'm co-portfolio manager of Block with Mike Venuto and also lead ETF strategist for the ETF Think Tank. For those who don't know, by the way, the ETF Think Tank helps out advisors with idea generation as well as social media. So with that, I'm going to hand the mic over to David to introduce himself, and then he'll hand it to Cynthia, and then Rob, you'll get the mic.
How's it going, everyone? David Chikansky here, fellow portfolio manager with this group. I manage the SoFi Be Your Own Boss, BYOB ETF, which is actually surprisingly in the smaller cap and mid cap growth space performing well relative on a day like today. But there's lots of exciting things we're going to talk about today, some signals that will help you guys in your practice going forward. So I'll kick it back to Cynthia for her official introduction, and then we'll hit it off with Rob.
Yeah, hey guys, always great to see everybody. And head of research for the tank and pilot of the technology today. But Rob, it's all you. We're really excited to have you here. Tell us a little bit about yourself and what you want to talk about today.
Great. And look, thanks to all of you for having me, and Dan for his longtime friendship. We go back a ways. And really, thanks to whoever it was on the ETF Think Tank team that decided you had run out of good quality guests, because I assume that's why Dan called me and said, "Hey, let's do this." No, I'm Rob Isbitts. I like to call myself an investing lifer. I also like to think that I have something to say to the advisor crowd, because I was one for 27 years. Here's me by the numbers. 58 years old, 42 years I've been charting stocks. My dad taught me when I was 16 years old with graph paper and pencil. If I wasn't sitting in the cafe with everybody here, you'd see a picture of my dad behind me. He passed away 9 years ago, and I make sure you can always see the screen. I think Mike and I have talked about how his dad, obviously very influential. Mine was never a professional in this business, but he has inspired a lot of things that I do now. I've been an advisor, I've been a CIO, I've been a principal of a firm, I've been a mutual fund manager 3 times. I've written for a lot of publications. What am I doing now? Well, 2 years ago, I sold my advisory practice. I think the nature of that sale was very instructive for a lot of advisors, and maybe even a warning sign, and we can talk about that later if you like. I went on a 2-year journey in search of intelligent life in the advice and publishing industries. I found very little, but I'm happy to say a lot of it is sitting right here. I asked myself a question: 36 years in the business, 27 as an advisor, now 2 as a publisher, researcher. What do I do to take all that experience, 100,000 hours of doing all this and obsessing over this investing stuff? How do I turn it into something that will live as long as and longer than I will, and again, it's all be in one place? And that is called modernincomeinvestor.com, which is my new research site, modernincomeinvestor.com. I also have another mission, which you can look up at theinvestmentors.org. It has a .org because in memory of my late father and others since then, my wife and I earlier this year started a charity that is devoted to taking people in many different professions, but starting with the one that we're all in, and trying to find the next Cynthia Murphy's, Dave Dzansky's, Michael Gaiaz, etc. Training them from the ground up, but doing it in a nonprofit way. And I hope that people from this industry will help me as we start that mission. Down here in South Florida, where I live, we're actually doing our first live event next week, and eventually we'll raise money and the whole thing. But right now, we got kind of an analyst training program, and so that's that is the other passion that I have in my life.
So with that, actually, we our drinking word today, or words, we didn't agree on one before. So, but drinking is very important to all of us here, at least on the tank.
I'm glad to hear. Mine looks invisible. There it is.
We're gonna do is it modern or modern income, either or, both, whatever.
Well,
Sense.
what do you think, Dan?
I think modern, because you can always say modern income, and
That's right.
I got to drink twice now.
So
That's right.
modern is our word for today. And so before the call, before we started the show, we were talking about what is modern income? And even before that, you were saying how to you, your definition of income isn't everybody's definition of income. So why don't we start that and tell us, how do you define income, and what is what's modern about the way you figured out how to capture it?
Yeah. So modern income, and by the way, it can be modern income. I guess I caught myself.
We're already getting drunk. Maybe like drink every other word.
No. That's okay. So we all know what can we get around this one, okay? We all know about MPT, right?
Yep.
Didn't say it. So to me, what is even more M than MPT is taking this secular issue that we have with what bonds used to do for investors. Everybody says to me, oh, you have an income portfolio. Well, it's an income portfolio if you want it to be, okay? And what I have done over the last 20 years, this is what I believe allowed me to get a nice valuation when I sold the practice 2 years ago, so I could convert myself into what I am now. But I also got a 10-year no-cut contract with the buyer. And why is that significant? Because the buyer said, your investment style is what's going to keep people here, and they just met me. And I said, that makes a lot of sense. And who were those people? When I met them, they were in their 40s and 50s, maybe 60s. Then they were 20, 25 years older. And what they always knew was, A, I could avoid big loss. And ABL is my number one rule in investing. The second is make as much as you freaking can, but ABL is more important. So how do you do that in an era where bonds don't do what they used to, and equities don't do what they used to, and it's happening at the same time? Well, to me, I've increasingly become more tactical over the years, to the point where now the way you generate what we used to call income, I think of it as cash flow. If you're an advisor and you go to your client and you say to them, you have $1 million, and we've decided from your financial plan that, or you've told me, hey, I need to pull 50,000, 60,000 a year, 70,000 a year out of that million. Well, how are you going to do it now without risking 20, 30% of the portfolio? And please do not tell me 60-40, okay? Because that's dead and buried. So instead, if you're cash flow oriented, or you just don't want to, if you just want to cap your drawdown at 5% or so, it can be done. I wouldn't say easily, although it seems a little easier to me because I've been doing it for 20 years. But and now I'm trying to teach advisors how they can do it themselves. And that's what modern income investor is about. So, and by the way, there was a modern in there, so there you go. Okay. So you think of it this way. If you went to a client, I actually just talked to an advisor about an hour ago, and I said, if you went to a client and you said, there's two things I'm going to do for you in your portfolio. I'm going to take every $100 you gave me and make it so that it never says less than 95. That's my first goal, and I think I can make it happen. Second, every time the value of the account goes from 100 to 101 or 2 or 3, we'll decide together you pull it out and you spend it. That kind of sounds like what bonds used to do, doesn't it? It also sounds like what a conservative investor to moderate risk investor to even a moderately aggressive investor might do. And the historical return, when it wasn't focused primarily on income, cash flow, we were running, a 7 to 8% return with probably about a 7-8% standard deviation. So it wasn't having the big drawdowns. And as time has gone on, we've gone to what I believe is you can't own it anymore, you have to rent it, okay? Kind of like they say about beer, I'm drinking wine, but you don't own it, you rent it, right?
So Rob, I mean, for some people like Warren Kaplan, he does covered calls.
Mm-hmm.
That's income, right? Is that modern income for you?
That is an existing way to earn income. And just so you know, what I do is in modern income, what I'm really doing is I am taking a very wide range of returns that you get in the equity and fixed income markets. I'm getting rid of this concept that you need to get cash on cash income from bonds and dividend stocks. Okay. And I'm giving you a narrow range of possible outcomes. Okay. That to me is how you produce income today. But I have no issue with dividend investing, bonds if you're really careful and really tactical, covered call writing. I think they're all great. What I'm doing is it's additive or complementary. It's not. It does not have to be a replacement. I'm not so egotistical to think that this is going to replace all those strategies that people have mastered, for years.
They say one of the hardest things for advisors to do is to train their clients as to what they should expect to see. Right? You hear some advisors say, you should expect to see one position that's down every single quarter, right? Like that's something that we always talk about at Throso. But it does, I'm probably of the bunch at Throso, the one who is most in love with rebalancing, right? Especially on swings in the market. And it does feel like this is like you're teaching your clients or the advisors that they should expect very, very, very strict rebalancing. Right, you get to the 103, you're going to go back to 100. You're going to put some chips on the side of the table. And I actually have to ask you, it's like, are you a blackjack player? Because this seems so much like position sizing in blackjack.
Not blackjack. And just so you know, it was only the income part of it is a recent iteration of. It's just the evolution of a strategy that I've been running in one form or another, including 3 different times as a mutual fund for the last 20 years. So it's not like if you get to 102, 103, if your client's goal is cash flow, this is how we're getting them cash flow. If your client's goal is, I just want to have a smoother ride on the way to making my, long-term 6 to 10% plus or minus whatever, or keep up with inflation, beat inflation. You don't have to pull the money out. I'm not a rebalancer per se. And when you talk about blackjack, it's not so much blackjack. It is low volatility, total return with no cap. That's how I see it. Okay. Of all the things that people are doing to try to create, and it's been a little while, so I'll just say modern income. So with all the things that people are doing, the one thing I really am not a fan of is, and it's not across the board, but the concept of structured products. You can do that actively. Okay, you can do that actively by saying there is a line in the sand. Okay, and if you're playing offense and defense at the same time, what does that mean? It means you are tactical, renting, not owning. You always have your offense on the field and you always have your defense on the field. So Dave, I will take what you said one step further. I will up the ante, if you will. Okay. Still not talking blackjack. And I will say that in my style of portfolio, if you don't have something up and something down, let's say over the course of a month or a quarter, if you don't have winners and losers, then we've probably done a pretty incredible job, because it's kind of a long short portfolio when you think about it. I use a lot of longs in a wide variety of ETFs. We call it the 101. We follow 101 ETFs for inclusion in the model. Why 101? Because my awesome analyst Soumya is from India. And when I said, here we are at 100, she said, well, 101 is very, it's like a sign of good luck and fortune and good feelings in India. I said, good. It just became 101 instead of 100. So I did that in her honor. And really, it's blackjack is not, if you're going to pick a game that that modern income investing is similar to, it's not blackjack. You know what it is? Fantasy football. Because it's all based off a grid, okay? And I see Ray smiling, so I'm guessing the under-over on how many fantasy football leagues he's in is 3. I don't know if I'm right or wrong on that, but maybe you can tell us later, Ray. So why do I say fantasy football? Because, and Cynthia and I were talking about this in the pregame, it's one thing to have a portfolio and a rotation and all that, but it all starts with process. So
can I interrupt you real quick? How about,
please do.
is it okay if I'll share my screen and show?
It'll be a lot easier, yeah.
Portfolio box?
Yeah, it'll be a lot easier, okay?
Let me show you guys what we're talking about here.
Yeah.
So let's see if this is helpful. Does everybody see it?
This is from, as you can see, it's from Modern Income Investor. So everybody have a drink to that.
Modern Income, how it works, and there is the portfolio box.
Yeah, yeah. As a matter of fact, this page of the site, if you're not one of these people who just wants everything in 8 seconds and then you move on to another subject, this one page, it's not that long, but it pretty much tells you everything that we're doing.
Yeah, I'll scroll down. You guys can see the whole process.
And I've recorded some videos. And this stuff literally went up like 2 days ago. So, as the site and the service is pretty new. Just so you know, I mean, we have 3 subscription levels. This is the master one. Okay, the platinum one. It's a 7x7 box, and I'll explain that in a minute. But do understand that there's a 4x4, which is a simpler, less, let's call it less granular, less precise, okay, version of the same thing. And then there's even a 2x2, which we offer for $4.99 a month, a break the bank price, because it helps people understand the concept. What's the basic concept? I would refer to it as floating beta. Okay, so replace this old idea of cash flow, okay, bond interest, stock dividend payments, okay? The problem with a stock dividend payment is that if you make 4 or 5% dividend yield, but you lose 5 to 10 times that in a bear market, you lost. And in the eyes of your client, you definitely lost. So what would you do? You go to bonds. Well, I mean, am I allowed to curse on here? You're going to cut that out. If you're going to cut it out,
say whatever you want to say.
Okay, so look, I mean, bonds have been a shit show in the making for
not that word.
Right, exactly, exactly. Yeah. You know what? If I'm fortunate enough to be a guest on this again, maybe we'll make a curse word one of the drinking words. Okay, then you'll get the other Rob. So anyhow, take a look at the box. All right. So, and this is about as close to what I actually do. And by the way, I don't just do it. I mean, I do this with my own money. Okay. At the beginning of the year, my wife said to me, is there something we can do to spin a little bit more income out of the portfolio in addition to what you make from this and that, whatever? Something I can put right in the account and pay bills with. I said, why? It's funny you should ask, because I was thinking about that, taking my core portfolio from 20 years and adapting it to spinning out income. So she will come from the other side of the house on a good day, and she'll be like, can I spin? Okay. So, to get to that point, you have to construct a portfolio that doesn't break. It can bend but not break. Okay. And so you can see I use the word bucket just because I figure people are familiar with that. Okay. But this is not like the bucket theory that's been around for a long time. 7 buckets, 2 for sure are offense. The third one is an offense, but it could be more of a wild card, a couple of defense, and then 2 pure, what we call wild cards. I can certainly answer what those are if you like. They each have different fixed model weightings. Okay. Can you rebalance back to them? Sure you can if you want to. But then really the key to this is look down the row at the 7 buckets. Those are like a fantasy football team where you're choosing a quarterback who gives you the most points. That's why it's 30%. So that's the most important decision, sort of ceteris paribus. You got a wide receiver for 20, you got a running back for 10, you've got a defense, you've got a kicker, whatever. Okay. It's not exactly, but similar format. So you got 7. Now look across the top. Okay. How are you going to play offense? Well, you could do it with the S&P 500. You could do it with the S&P 100. You could do it with the S&P top 50. You could do it with the NASDAQ. You could do it with growth, value. I've got my own way, and I show it to you on, in the subscription service. But part of this is just teaching advisors and even the sophisticated do-it-yourself retail investor how to take this and, like they used to say in American Idol, make it their own. Take the song and make it your own. Well, that's what you can do with this. So you've got 7 buckets and you've got 7 choices across the top. If you want to make it 20 choices or you want to make it a stock portfolio, fine. But this 7x7 box gives you enough flexibility, but enough constraints so that you can operate this portfolio kind of like a fantasy football team, same end goal, much more serious amount of money, which is make profits as consistently as possible, spin them out if you're income oriented. But again, go back to that $100 shouldn't go below 95 cents.
So are the wild card options part of the same pool as offense and defense, or are these 3? Are they 3 unique pools, 2 unique pools, or 1 unique pool and a position can be offense, defense, or wild card?
I know it sounds cliche, but that's a great question. Everybody says that, right? Oh, that's a great question, but that really is a great question. So, and in fact, we made you take the offense positions, the defense, and the wild card. You can define them however you want, but to me, the offense and the defense is basically like a long and a short. Okay, I think I mentioned in the pregame that think of it this way. Okay, if you ran a 2-security portfolio this year, all you owned was the Dow long ETF, and you owned the NASDAQ inverse ETF, single inverse. I'm not a big fan of the doubles and triples. If you are, go with God. But if all you did was you had Dow long, NASDAQ short or inverse in the same proportion, you'd be up a lot of money this year. Because all you had to do, and again, I'm a chartist for 42 years, so I don't want to sound like the chart whisperer, but I mean, the market tells the story. We just have to listen. That's my old expression. And what I was listening to early this year was this looks like more than a brief period where the Dow is going to outperform the NASDAQ, and that's what you consistently see in every one of these dips. And when you get a bull market again, I'm sure it'll reverse, but not until then. So that's a very simplified way to say I have offense and defense on the field at the same time. if this is a taxable account, by the way, for you advisors that are tax savvy, which is probably most of you, when you are playing offense and defense at the same time, just in different gradients, okay, it is naturally tax efficient. This goes back to what you were asking before, Dave, right? You're always going to have, well, you won't always have a winner and loser. I'm kind of delighted at how many days this year where our entire portfolio of 7 ETFs was up, because there were days where maybe the Dow was up, the NASDAQ was down, so our inverse was up if we were still holding it. The Russell was down, and the wild cards, which are generally sectors, industries. Can I name a ticker that you guys are familiar with?
Yes, please.
Okay, good. So in either bucket number 6 or 7, doesn't really matter, the wild card is, well, let's see, I was going to say rhymes with, but I could get in trouble. Block, ETF. Okay?
It rhymes with block, or it is block?
Was that? No, it is block.
Okay.
It is block. Okay. And by the way, if you look through the box, okay, we follow 101 ETFs. Obviously, 7 by 7 is 49. So we have 49 in here at any one time. We try not to make a lot of changes to it, but this is, and this is what I call a depth chart. Again, kind of fantasy football-ish, but isn't really how I came up with it. But I am a sports fan. So this is the depth chart. You can see most bullish to most bearish across the top. In bucket number 3, okay, your 10% offense bucket, you've got, you look inside the site, and we name names, obviously. This is just a sample to show the technique. The ETF on the left is going to be a lot more volatile, okay, than the one on the right. You would more likely have let's call it a QQQ on the left, and the most bearish, it could be a lower volatility, something like that. And as you go down the list, it gets more granular. I would not put 30% in block. Would I put 5% in block since I'm a tactical investor? Hell yeah, at certain times.
So it seems like the wild cards are super high active share, concentrated ETFs, right? Probably like 20 to 50 names that have minimal overlap with the S&P. And would I be correct to then say that bucket number 1 is the opposite, where it's like pretty much everything has like a 40% overlap to the S&P and even the top 50 ETF, right? The biggest, right. The number 1, pretty much, at least my version of it, the number 1 bucket is a lot of different versions of the S&P, differing only by things like concentration and maybe tilt. And then when you get down to the bottom, okay, look, I was going to ask on the top bucket, right? So I'm curious how the Dow has held in that top bucket the whole year. Was there a rotation into value at some point during the year, or did it kind of hold strong in the Dow? And what are your thoughts on why that was so consistent, or is that kind of normal in your system?
So before, back in 2020, my track record is right on the site. I mean, you don't even have to like go behind a wall or whatever. Okay. So the modern income track record is up there, and you can see it. I would call your attention to February, March of 2020. The market fell 33%, and the version of this strategy I was running at the time, which is pretty much the same as I run it now, but just with a little more structure added now. We were up 2.5% in those 5 weeks. So you can look at it as a 25% annualized return, or you can look at it as 2.5% in a minus 33. Either way, I don't think I ever sold the Dow position that I owned back then, and I cannot believe how much this year, parts of this year, have rhymed with 2020. And it's like I'm going back to the old playbook. you know?
I've always been fascinated with the Dow because how it's constructed, it doesn't have any impactful value. And so I've always shied away from it. I've never owned the Dow. So convince me why, like, I'm so intrigued.
Sure.
Why is the Dow this like portfolio anchor in your eyes?
I'll tell you exactly why. And by the way, if they had more liquidity, okay, I mean, they have enough. Maybe we'll use them at some point, but there are three versions of the Dow, right? There's the quirky, you know, traditional official version. There's an equal weighted Dow ETF, and there is an income weighted Dow ETF. But if you just look at the Dow 30, here's what I love. Okay, the Dow is only 30 stocks, and realistically, for what moves it, it's maybe 15. I'm a chartist. I like the idea that I can see through to any ETF. If I mean, one of the screens I should say, one of the panels I keep in my charting system, which I'm in all day and night, is the Dow 30. And I could just zip down the list and say, good, 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 maybe, good, 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 bad, 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 etc. Okay. So if I can do that, then I know what my core portfolio looks like. And in the same way that you go to, let's say, you know, Chipotle, and you say, okay, this is my base. The Dow is a nice base to me because it's so transparent and so easy to analyze. And then, so as an example, the very first thought that I have, if the DIA is filling that 30% slot, is I better make sure that if it becomes a all tech all the time kind of market in the large caps, okay, I don't got a lot of FANG exposure in the DIA. So I have to make sure that in my box, I have enough support, if you will, in bucket 2 and in the wild cards. By the way, in the wild cards, okay, sometimes we have opposites, okay? I don't mind telling you, I have long bond long and long bond short ETF in the same bucket, okay? I believe it's bucket 5, bucket 3 actually, okay? Because I'm not gonna own them both at the same time, but they're a really nice supplement to things sometimes. The other thing is, and I wouldn't call this cheating because after all, if your goal is to keep your portfolio within 5% of where it started at all times, okay, and then pull out the income if you so choose, okay, or the cash flow, the profits, you know, then you would like to have the ability to not force yourself to be exposed to equities. And we had this condition very recently, and frankly, we have it right now. And we had it in February, March of 2020, where the offensive bucket, 30%, would be in some type of long equity. And the 20% and the 10% offense buckets are not in offense at all. They're in T-bills, or they're in very short-term bonds. Although this year now they probably be in T-bills. So even though it says offense, sometimes the best offense is just not putting forth any offense. Also a good defense, yes, but the defense.
That was the Mr. Miyagi moment, right?
Wax on, wax on, wax off. That's right. That's right. But think of the range. Think of the range. And again, look, it's not just this. It's in general. Okay, how do you handle these types of markets? If you're going to war every day with the idea that don't worry about it, clients, the market's going to go back up, or you know, it's time in the market, not timing the market. Okay, bullshit. So. I look at this right now as a battle for financial survival for anybody that manages money for a living, or and even if that person is themselves, okay, if you're managing your own money. And because I don't like what I see, well, I should say, what I see coming, and you know, like we may have just had the appetizer, okay, for what's coming. And even if it isn't that case, at least I know that I have a box and a strategy and an approach and a methodology and the technicals, all put it all together and wrap it up in a box. Okay. I have something that will work in any environment. And how do I know? Because I would guess that on the days that the S&P this year has dropped more than 1%, and there's been a lot of them. I believe 60, it's hard to quote me on this. I believe the majority of the days the S&P has been down more than 1% this year. The modern income portfolio was up. Okay, why? Because there's a lot of little tricks that you can put in there. As an example, you want to take a portfolio that's generally bullish, offensive, and give it a tail risk hedge. There's a lot of ways to tail risk hedge. You know what's a really good tail risk hedge if it's that type of market? VIXI. Okay? And my minimum position is 5%. So if the rest of my portfolio was long and a little bit of defense, and I had 5 VIXI, that if anything, it can get you in trouble the other way if you're not careful. I can also own VIXI and SVXY at the same time, and that's like a long volatility trade. So it's all in there as I see it.
Careful, Rob. You're intriguing our vixologist. I can see Jim smiling there. Jim, is this like a trade you've had some fun with? You're muted.
Let's just say that I'm familiar with the exchange traded products that have VIX futures as the underlying, although it would be very rare for me to own long and short at the same time.
Yeah, in 2020, what I did in my model portfolio for when, still when I was in the driver's seat, I was the advisor to the clients, and after that was when I sold the practice. So back then, we were using just a long combination, which I understand is called a long strangle, but I didn't want to use that word. And so I found out it's also called long combination. So, buy calls above, buy puts below, hold them at the same time, alternate the allocation between the two to fit the chart pattern that I saw. Everything's about, look, you can make money in any investment at any time. The difference between one investment and another is what's the risk of major loss. And so the problem, Jim and everybody, was that after 2020, I looked at it as a God, I'm worn out. Well, no wonder I'm worn out. I had like 84 model changes in 6 weeks, okay? Because I was doing so well with the options that they were, and my rule was when it doubles, roll the strike, okay? Roll the strike, shorten the expiration. So I did it the options way, and I'm just like, shit, this is wearing me out, okay? And the clients, believe it or not, were like, I don't know, we're doing pretty well, but I know the market's down 33 and you're up 2.5 in 5 weeks, but a lot of trading. It's like, okay, well, fortunately, whatever. I love my clients, and I really like the guy who bought my practice, but I said, he and I both agreed, the next time we have a 2020 whatever scenario, and this is the closest thing we've had to it since then, I'm ETFing all of it. And okay, and I really meant that by ETF, not meaning I'm ETFing all of it. So okay. Yeah. By the way, you know what the earlier version of Modern Income Investor was called? But its name didn't catch on. But I still own the URL, so anybody who wants to maybe market it. It was called ETF Yourself.
I like that.
I own etfyourself.com, but I couldn't get anybody to notice it because I don't have the marketing machine that is Taroso.
Well, this is
I'm
proof
a little
positive.
pitcher.
This is proof positive the Guyad's not actually on this, because he would be all over that.
I was going to say we should auction this off right now. Like, can we auction this live on the show here?
Oh, I have so many ETFs. I have a lot of intellectual property
Honestly, all of us do. That would be a fantastic show. Let's all show our ETF URLs that we have.
Our favorites, yeah.
Fine. Is it going to be like the that high-low card game where everybody puts the card on top and is okay? I want that one. Yeah.
Hey, David, I like that idea though. Actually, that'd be a lot of fun.
By the way, they're all for sale. Just so you know, they're all for sale.
I have ETF analysts. Like I have so many too. Oh,
yeah. Good. Okay. I'll look forward. I'll look forward to
like trading cards.
To trading baseball cards with you. Yes. Just don't get any stuck in the spokes of your bicycle.
I have Structure Matters, by the way, in case anybody's wondering. Go ahead, Cynthia. You got a question.
By the way, Attack the Bear is mine. Is my favorite.
I was gonna say, well, careful. Whatever we say here is binding, Rob. So if you make us any offers, then you've got to deliver.
Well, I believe I'm no lawyer, but an offer includes a price. So yeah.
And I have Structure Matters the ETF professor. So if you want to trade, let me know.
But so actually, Dan, you have your hand up. Do you have a question, or I
always have questions,
but I don't see. Yeah, I don't know if I try to promote as many people here as I could. The system's not promoting anymore, so if anybody has a question, just shoot. But I was gonna actually, like, we're coming up towards the end. We did this for about 45 minutes, so I just want to make sure, Rob, that we have a moment for you to tell us about your nonprofit. Because it's a really cool cause and effort. So I just want to make sure before we circle the wagons that you have a moment to tell us about that.
Yeah, that's right. And certainly I welcome any questions or any follow-ups from anybody that's that's attending here today or who listens to this on recording, as I often do. So yeah, the InvestMentors.org. When my dad passed away in 2013, my wife and I started one of those donor advised funds, and we realized the problem is all you can do is you can write checks to other charities, and there was no charity that was trying to solve what I believe is one of the greatest problems of our generation. There's a gap. Young, aspiring professionals, they have that gap. They come out of school, and they may have a lot of debt. They probably don't have enough opportunity. And they didn't have parents like maybe a lot of people that are on this call, okay? They didn't have people that could help them with a path. They didn't help people that could mentor them, who could help them network to get an internship or help them choose a college even, okay? But once they get past that, they're out there, they're either getting close to the end of college or they're in the first 5-10 years of their career, all the people, we want to perpetuate our own industry, don't we? Okay. And look, I'll go on record, as I have many, many times on many, many podcasts and such, as saying one of the biggest issues, other than lack of a clear career path, okay, the bigger issue in our industry, there is way, way, way too much testosterone. And we need to get more women in position to do what they should be doing because they're smarter than men. And the same thing, look, so I've kind of gone out of my way over the last 10, 11 years when I ran the firm, et cetera. Okay, we brought in interns galore, and I learned a lot from working with that generation. Some of them went on to really nice careers as analysts or things in and out of the industry, et cetera. But the issue is right now, okay, there's a lot of people who are aspirational, but they don't really know how to get from here to there. And it could be mentoring, networking, or even gap funding. And so we set up a charity, theinvestmentors.org, theinvestmentors.org. We're actually, I don't know if anybody here is in South Florida, but next Wednesday, we're having our first live sort of casual networking event at a really cool place in Fort Lauderdale. But we'll probably do this once a month. But we're about to kick off our training program, and I would love, the good vibes, spread the word, whatever, of anybody listening to this, because I'm creating basically a analyst trainee farm, people who can write about ETFs, people who can write about equities, people who, you know, want to either be analysts, portfolio managers. I don't care if they want to be in the back office, but they want exposure and they want to put some points on the board early on. That's what the InvestMentors is going to do. We're starting with our industry, and then we're going to move to things like healthcare, which is big down here in South Florida. And you know, we're still filling out the board. So that's my other passion. So thank you for letting me speak about it.
Well, as somebody who believes in modern, I don't know, I was gonna say modern portfolio theory, but I didn't want to get shot. Happy to sign up because that sounds like a lot of fun. I'm a big believer in mentoring, so can't say that enough, of course, as the ETF professor. So
That's right.
Sign me up, man.
Yeah, great.
No, and put on the chat. I'm trying to I meant to type up the URL here, but I moved too slow. So if you don't mind doing it one more time, Bob, we can put it in there on the chat so people can check it out.
There it is.
Yep. Did he put it in?
Mm-hmm.
Cool.
Actually, I sent it to Warren. Well, hold on. I sent it to Warren.
Okay, Warren, we expect you to get involved.
Hosts and panelists, is that who I send it to?
Yes.
Yeah, there's a
please.
problem with the chat still. It's just not going. It's not going to everybody apparently, but that's okay.
There it is.
Oh yeah.
There you go. Good job.
InvestMentors.org.
Okay.
Yeah.
Are
Love
there some other questions? I mean, I love the Q&A. So
Yeah, I mean, so I'll put a plug in for myself. How have you worked with the ETF Think Tank? We actually, the funny thing is, you know, a lot of people sit back and listen, but I'm not sure they understand what the ETF Think Tank really does.
well, I will tell you this. Okay, as what was it, De Niro said in Scent of a Woman, you know, when it comes to our interaction with the ETF Think Tank, I'm just getting warmed up because the other initiative we have is something with Seeking Alpha. I'm going to start writing for them, and a lot of the analysts that we actually train through InvestMentors or just through Sun Garden, my main company. We're going to basically teach them how to be contributors, writers. And one of the niches that we have found is writing about ETFs that are under the radar. And I would call under the radar. I mean, I used to run a portfolio, sort of a one-off deal for somebody called the Undiscovered ETF portfolio. And it was 250 million market cap and below. I still think that would be a great idea. I just don't have bandwidth for it by myself. But instead,
Well, the challenge is that's about what 85% of the ETF market.
Well, that's the thing.
A lot of undiscovered rocks to go flip.
Well, that's right. You guys know as well as anybody else. So to me, like, you know, I can't wait to get some of my analyst mentees to get on the phone with the people who actually created and ran a lot of these ETFs. One thing about what we're doing is that the less often an ETF or a stock is written about, the more likely we are to cover it, because I'm effectively being one. I want to be the sort of champion in that space for bringing light. And look, we have our own rating system. Okay, I've got proprietary ratings and grades. Probably got 10 of them. And to be able to apply, it's one thing to apply them quantitatively. Okay, like a lot of people do. It's another to go and then say, this is why I like it or don't like it, or why I like it, but maybe in a market like this, you know, everything's a hold or a sell or a strong sell, spare a few, but kind of watch for the next bull market, you know, because this thing can go up, you know, that type of thing. So I think that interaction, I think there's so many rocks not covered, I should say, things hiding under rocks in the ETF world. You guys are a big part of them, and trying to give life to those. And I can't wait through this analyst group to put you in contact with a bunch of young and hungries, as we say, who will do what, Dan and I have done several times, which is, get one-on-one with the people who create these things and really understand it. It's a lasting memory, no matter whether you love it, like it, or not sure. It's always a lasting memory. Okay, I can still remember the ticker of everyone that I have been, allowed to go one-on-one with, thanks to Dan and Chris.
So we did a call, and I don't know that I brought the idea to you, or we had the idea that we spoke about on BTAL.
Mm-hmm.
That's got to be screaming in your process at this point. Am I off on that?
No. So here's a great example of something that I would say is probably well suited to a 4x4 box and less so to a 7x7 box. Why? Because the more ETF, and this is why we have 3 different price levels in modernincomeinvestor.com, because for some people they just want the basic concept, how I call it a ROAR score, reward, opportunity, and risk. It's my own indicator, and it basically says every week, if you have $100 and you can be in equities or cash, how much is in equities? The current reading, and for the last 3 weeks, has been 10. It can go up to 100, obviously. 10 in equities, okay? I don't allow it to go short, maybe one day. The next level up between that and the 7x7 is a 4x4. So what would you use in a 4x4? You would use something like BTAL, which covers a lot of ground because you don't have the silo nature that you can in a 7x7. Like, for instance, block might be too much in a 4x4 portfolio because you can end up having 10, 20% of your portfolio in it. And, if that may be too much for people, especially if you're starting with the idea that you want to cap your drawdown at 5%, okay? You can't control the market, right? And you can only hedge that thing so much. But BTAL, good example of something that would be in more like a 4x4 because it covers so much more ground, is giving you long and short effectively in the same package. And it's, So that's,
so can I ask, so what if BTAL had more volatility to it? Would it be an eligible member for the 7 series? No, I'm asking because it does seem like you have more thinner slices, and you're looking for maximum returns in whatever direction that position is supposed to provide in that bucket. It seems, unless I'm mistaken.
That's right. When the 7x7 is a offense, defense at the same time portfolio, it's a little harder to put one of the components in that is an offense defense combination itself. It's why
you use defense. It's just muted volatility defense. It's not like as much on the upside as you would want, right?
Well, look, I've been looking for not just because of this discussion, but it don't hurt. We're always evaluating what should go into the set. We follow 101, 49 make the roster, or let's say the depth chart at any one time, 4 short of an NFL roster, I will say. And those are exchangeable. Okay. I mean, I kicked out VXX. There you go, Jim. I kicked out VXX because honestly, I can't figure out why the hell it is doing what it's doing based on what it holds. VIXI is a little more pure. I know it's not perfect. It's not the same as put options or futures, whatever. Okay. But again, going back to something like VTOL, yeah, I mean, in an environment like this, where on defense, you're looking for as many gradients of defense as you possibly can, because there's such a shortage of offense. Okay. Then yeah, it deserves a closer look. And again, we're just talking about the box that I create. Okay. One of the applications of Modern Income Investor is that, at least for an advisor, we have an institutional service level. And a lot of that is, okay, tell me what you want and I'll help you create a box. I just can't give you personalized investment advice because I dropped my licenses and I'm out of that business, and I'm a publisher and a researcher.
Well, Dan, should we wrap it up? We're coming up on the top of the hour here, Rob. So I wanted to thank you. I will quickly share my screen just one final time if I can find, oh, maybe I won't. Oh, there we go. Just to quickly share the charity. This is the right
Good
page,
for you.
right?
That's the one.
Okay.
InvestMentors. Yeah, it's cool.
So I thought a great way to finish with a great cause. And thank you for joining us today, Rob. Thanks everybody for coming. As always, it's so fun to see everybody's faces. And if you wanted to be a panelist and I didn't promote you, forgive me. Next time, then we'll run the technicals and the flying will be a little smoother. We required a seatbelt today, but next week should be smoother flying.
And just for the record, besides Cynthia, Lily was out there as a woman financial advisor as well. I felt bad actually. There was only two women there. We've got to recruit more women when it comes to mentoring. I think that's important. You know, I really do actually. It makes me smarter.
I think the InvestMentors could certainly try to help with that, because I'm about to open the door to anybody who wants to get trained to learn more about this business, and I'm definitely going to need some help in the virtual classroom, if you will, guest professors, as you were. So.
Oh boy, you used the right word. Dan signed up. Professor, that's always required. So. Sold for him.
Thanks, everybody. See you
Thanks
next
all.
Thursday.
Thanks again. Bye.